Hi, this is Jean Joe, broker and owner of Perisson Real Estate, and I'm back with another edition of Perisson Pulse. It's incredible to think we're at the end of March now, which means we're 1/4 of the way through 2024. And I really hope the year has been treating you well so far. It would be an understatement to say that we've been experiencing many developments in the real estate industry that may be changing the way that we work in the near future. For today, however, I'm going to take a break from that and we'll be sharing with you a portion of a video from one of my networking groups last week. We were joined by Niles Lichtenstein, co-founder of a company called Nestment, and this is a very intriguing business model where they help enable people to team up, whether in groups of two or more, to purchase real estate together. This can be investment property, and in some cases, the investment property could actually be the first real estate purchase of a client or purchases of multifamily property like duplexes, triplexes, and fourplexes with the intention of living there. The biggest focus and demographic for Nestment has been millennials who are increasingly seeing the value of owning real estate, but who may be hindered by the lack of affordable housing supply. I think this is a great opportunity that will be a growing movement in the years to come, and I hope you'll find this video as interesting as I did.
Hi everyone. Glad to connect. I'm actually calling you from uh Jersey City here, where I actually co-own a building. I'm in the cafe. There's a cafe, and then there's two residential units above it. One of our sometimes occasionally when we have groups of people who come together, there's opportunities for myself as well to invest alongside with them. And Jersey City is a really interesting place because Airbnbs have been essentially outlawed in Manhattan. And so we're testing both the long-term unit and an Airbnb unit in this particular building with the coffee shop below. We're calling it Airbnbs. That's our little inside joke. But in any case, thanks for having me. It's been great to get to know Gene and Elsie, who've both kind of forgotten more than I've ever known about real estate. So, I'm excited to share a little bit about what we're doing at Nestment. I'll share that through a document, but I think the major themes are that we'll be touching on are just, our focus has been around millennial and Gen Z home buyers and how in an unaffordable market they're finding ways and things that folks like Elsie have been doing for decades, but actually how we're taking those strategies, bringing it to a more mainstream buyer and a younger buyer, and then also working with folks like Freddie Mac through their Home X program and other folks to actually change the structures, whether it's being able to have multiple loans on one home or figuring out other things of that nature, being able to transfer into LLC with no issues, all of those types of things. So we called it Nestment because it was all about this notion of homes being part of your generational wealth. And I'll tell you a little bit about my own story, but both your nest and your investment, something that more and more folks from, I'm a millennial, are my generation and a younger generation are scared they won't have. You see those stats around how many are renters or what percentage of millennials are home buyers, which don't even take into account all the millennials who actually are still living at home or in a parent's house because they're off the board in terms of when they report on statistics. But more specifically, what we focus on, and again, all these things probably are not new concepts to you all, but to a lot of folks, they are new. But around this notion of how can millennial and Gen Z buyers hack this housing system and leverage co-buy models to become homeowners. The three groups that we tend to focus on are the first group is a term we're coining called shift. So second home is the first time buying. I'll give three examples of that. So one could be Selena and Wade. Selena and Wade were a two lifelong friends. Here, I'll pull this one up. Two lifelong friends who lived in Brooklyn. They're turning 40. They still don't own a place in Brooklyn. They're making good money, but they can't afford, right? So what they decided to do is they started by buying their first place in Hudson Valley. And now they're able to not only, make some rental income off of it, but, they're able to psychologically feel like homeowners, start to build equity. They had been looking at the last 10 years and saying, hey, we've been losing a lot of opportunity for all of this equity appreciation as we sat there kind of saving. So this has allowed them to do that. On the other hand, we have, even as young as 23 and 24-year-olds, we joke for a lot of those who are in like tech or finance that February and March is your bonus season. And so we had a campaign, it's bonus season, buy a home, not a hangover, right? Don't just spend it at the bar, right? So these guys were high school buddies. Then they graduated from college, got into the working world. One of their bonuses wasn't going to buy them much, but as three, they were able to buy their first long-term rental property down in Tampa, Florida, and it's renting out and so forth. So those are some of the interesting case studies around this group that we call shift. So, oops, sorry about that. Just one sec. That we call our shift buyers. The second group, well, I'll mention a third one because I know you all are in the South Bay. So we actually have a lot of, and it happens to be a lot of first-gen immigrants who work at tech companies who can't afford, and we'll come to this later because I think it'll touch on the primary multifamily when I go into that segment, but they can't necessarily afford what they want in the Bay Area. So I'll give an example. Praneet and his wife, Indian background, engineers at LinkedIn and Mountain View. They can't afford what they want in the Bay Area, so they actually are starting by buying a place in Atlanta, right? A rental to a duplex in Atlanta and things like that. And I can show you more about how our system works and helps them look up data that we pull from different data sources and things like that to help them do financial projections and things of that nature. But those are kind of really some really interesting examples where, we've always been told that, buy your primary home first. But if it's going to take you 10 to 15 years to buy your primary home, maybe buying at your second home first is actually the right decision. So that I think is kind of a new phenomenon. The second major group is what we call kind of primary multi-unit, or I know multifamily really is considered 5+ when you talk to Fannie and Freddie, but no, the kind of terminology from a lot of just folks that I talk to has now been kind of, primary multi-unit, but this is what also the kids call on TikTok house hacking, right? And you hear this a lot, where a few of them are going in and they're buying a 2 to 4 unit. As we all know, they're getting that at less per square foot than a single family home. They're replacing their rent, which is usually pretty high already, with a primary, and they're oftentimes generating rental income, have a tax write-off, and building equity. What makes this even more interesting is obviously there were the FHA programs that you had before, but now Fannie's program that just came out in November, or you can put 5% down. Obviously, California is a slightly different place. You might have to put a little more than 5%, but just that you don't have to put that 15 to 25% down. You could be less than that, and you can use the rental income to get approved for a higher loan. So that's a pretty big deal for a lot of the folks. I'll show you a couple examples of some of those. This one was really interesting. So Weldon and John, they're two Black engineers, computer science and mechanical engineering. I remember in their interview, they said, "Hey, I was told if I go to a good college, they went to UC Berkeley, and I get a good job, I'd be able to afford a home. And every time I saved up money, if I saved up 25K, they told me I needed 50K. If I saved up 50K, then I was told I need 100K." And so, they kept on going like that. And finally, they were able to leverage this Fannie program and buy a quadplex in Oakland. They're moving into 2 of the units with their wives and actually renting out 2 units. They're going to get to build the community that they want there. They get to stay in beautiful Oakland, and they were able to make it work with just 5% down. So that's a great example. These two gals were unmarried women. We have a lot of unmarried women who are looking for financial freedom, who are coming together, as well as even single moms who are coming together, which can be a really interesting opportunity. They were buying in LA. They were part of a women's running group, and they started talking about shared ownership. I mean, all of these cases were people who, when they found out about Nestment, found out it was really possible, like just said, "Hey, we're gonna do this." They ended up getting kind of your typical Spanish style home, but it's near SoFi Stadium, near Inglewood. It's got an ADU for rental income, which, as we know, with AB 1033, there's now some pretty interesting opportunities around ADUs in California. So these are examples of our primary multifamily. I think, Elsie sent some really fascinating stats recently around let me go back to the around the number of multifamily or multi-unit, I should say, 2 to 4 unit buildings kind of expiring or canceling. And it seems to be at a price point that's a little too high for your family per se. And they're kind of sitting there. But it becomes an amazing opportunity, especially in maybe marketing this together. Like, here's a strategy. We're actually having a workshop for folks in Oakland and San Francisco next Wednesday, and I'll send you all a link to it where we're going to be talking about that, because increasingly you have folks who are saying, "Hey, let me not be a renter. I can live with 2 other friends. In fact, I have my roommates now. We're all of a professional class. We can go in and move into a 2 to 4 unit building." So that's the second segment. The third segment is parent-child models. So I know all of you have tons of experience with this because in Dubai, in the Bay Area, oftentimes you're getting gift money or things of that nature. We find that people are just coming to us and saying, "Hey, is this a gifting relationship? Can we make this a co-ownership relationship? What's the difference?" I'm also working on more of a pledged asset solution, which I think could be really fascinating, where if you're a baby boomer and you're on fixed income, you have the ability to, and you don't have any capital to necessarily help your adult children, you can pledge the equity that's at a low interest rate in your home, similar to how Fannie and Freddie allow you to pledge stock portfolios. So we're testing out some of those models with nonprofit lenders first, and then we'll bring it to some of the for-profit lenders that we work with. All this to say, historically challenging real estate world, but that's where innovation happens. And so what we're trying to do is really be the voice and the platform to drive that movement. And those 3 segments are where we're productizing solutions. I went through, some of these case studies, but I think the thing that's most meaningful to me is that unaffordability is what dominates the housing headlines for a lot of us young folks. But we feel that we're rewriting the script. This is actually the story of Israel and Sam. You can probably tell by the background I'm sitting, and they dreamt of opening a cafe and they ended up buying the building, which is a pretty awesome story. When we look at it as a consumer opportunity, obviously in a healthy year, you're doing somewhere between 5 to 6 million transactions in the US. We think about 2 million of those will be Gen Z and millennial. But if you break that down even further, there's about 31% of those Gen Zs and millennials who feel like they're always renters, but they would buy if they could. So if affordability changed, so at least 600,000 homes. I mean, we definitely have appealed to the broader Gen Z and millennial group, but if we focus in on those 600,000 homes annually that could be candidates for co-buying, that becomes really interesting. A little bit about my own path and why my journey brought me here. So I was born and raised in the People's Republic of Berkeley across the way. I went to Berkeley High School. My father passed when I was 13, and and my mom was an immigrant from Malaysia. She's Chinese Malaysian, and didn't have a job at the time. Had 2 boys. And we didn't know what exactly we were going to do. Didn't have a ton of savings there, but we did have a home, and we felt very fortunate to have a home because obviously in a place like the Bay Area, it had appreciated. So at an early age, at 13, I learned how to help my mom through the paperwork of refinancing. And then we also kind of became, those first house hackers where we rented out rooms to UC Berkeley grad students. I was telling Gene and Elsie, it was, there was Nigerian math PhDs and Swedish physicists at the dinner tables. And outside of having to sleep in the living room sometimes and sharing bathrooms, it was pretty fun for the most part. I went to Harvard for undergrad, came back to the Bay Area. My first startup was in the mobile tech space, and that was sold to a company that went on NASDAQ. And then I had a little bit of extra capital now and was looking for what I would do next. And I was talking to my cousins who lived in Oakland, and they were like, "Hey, with all these IPOs happening, we're never going to be able to afford the Bay Area." So I started with a triplex in Oakland off Piedmont Ave. It was a tenant in common situation at first, and then became a cash generating LLC as people moved out. And I think one of the most meaningful moments of my own life was refinancing that particular property in early 2022 before rates went up, and giving a sizable check that's now gone to my cousins' homes. But I found myself, whether it was vacation rentals or I live a Nestment life now, we own a building in Nob Hill. We live on the top floor, another family owns and lives on another floor, and then we rent out units. I also found that my employees at my second startup, which is a New York Times funded startup called Inwoven, that I had a lot of staff and colleagues who were complaining that they couldn't afford and they wanted to buy a vacation home or something like that with friends as a way to get started. That turned into, for me, a landing page, right? And so anytime you have an idea, my thing is I look for reasons to say no. I know this is not about startups, but I always look for reasons to not do things. I'm busy enough. I've got two little kids. But this just kept saying yes. We put a landing page up with a very simple proposition: buy property with family and friends, flighted some Instagram ads for millennials and Gen Z, did a LinkedIn campaign, and then we had all of these people reaching out, and we just learned from them as much as possible what we could do to help kind of help them through the process. And it was everything we all know, right? And this was 2022, right? And so historically, interest rates were continuing to rise, and people were saying, "Wow, now it's costing me two times the salary to purchase the same home I might have been looking at in 2019." And I don't know if you all read the latest B of A report, and they come out with this every few years. But now home ownership for millennials has surpassed marriage and kids as most important, and even surpassed career fulfillment, which I thought was really interesting, right? Career fulfillment was always actually above owning a home. Now it's actually below owning a home. And I think you also have that because, you've got your millennials turning 40 saying, "Hey, we need to be able to build." We have a lot of early Airbnb angel investors in our company. And the reason why is because they also saw something similar, that this kind of sharing economy, these we ideals, could come into play. And I think that's something interesting to look at. What we focus on at Nestment, we're building a whole suite of tools and an ecosystem of partners. But when we did all of these interviews, there were five main areas of friction we were trying to eliminate. The first was just group alignment. We found that there were a lot of groups who had actually had this conversation with their family and friends because everyone loves real estate, everyone talks about it. It inherently makes sense, but people don't have a clear starting point. So it was important for us to um, be able to give people their own dashboard, right? So this is the two women runners in LA. We had a roadmap where, as they're going through their roadmap and they're making progress, they're getting education automatically sent to them along the way. They're building their agent and lender team. They're being able to finance and close things. Along the way, we're introducing them to their agent and lender. And being there for moral support. They're also able to grab listings. So they're able to import from Redfin or Zillow any listing and do financial projections. I think I was showing someone the other day who was interested in Austin because before, when I would look at places, I only had historical Zillow data to pull if I'm just kind of a user. But now we're able to pay for, core logic data and actually look at forward-looking appreciation. And a place like Austin, right, is not, the appreciation's all baked into the pricing, but you wouldn't know if you were looking at historicals, only if you were looking at forward-looking. So we have things here that, look at kind of monthly cash flow, long-term rental, short-term rental. We're adding a multifamily calculator in here. The group can play around with it. They can kind of look at one, two, three partners. They can, even if they're trying to Airbnb, explore similar properties. And we also have a whole data team that supports people through the process. We recently came out with a list that we called our Nest Rank cities. We did a few different things to create these composite cities. Because again, take Praneet as an example, someone who's living in the South Bay, but doesn't have enough money to buy something there, although I think primary multifamily starts to become very interesting there for him and friends or family members, but is interested in buying their first investment property. So we started actually creating Nest scores based on looking at everything from leading growth indicators like realtors hotness ranking, which takes the time between for sale and pending, and gives every city a rank. We reverse engineered Zillow's top list, and we took our CoreLogic forward-looking appreciation data, which is more of a lagging indicator. It took things like cap rate, and just started, being able to create a list that people could sort, and depending on what they're looking at. Obviously, people have different different ideas of what they want, but it can help them start to think about it. We're adding in really interesting layers to it. So my co-founder, I joke, here, I'll pop in his case study. But my co-founder, a joke he built a startup just to be able to afford, but he ended up, buying his first property as a shift buyer on a golf course in San Diego, a top 100 public golf course. They're all renters either in San Diego or San Francisco. So what we're now starting to do with this data is we have an internal project called Lifestyles Over Listings. So you'll see soon something that takes all the public golf courses and actually ranks those courses, and then depending on the what you can afford, actually says here's where you could buy a vacation rental and things like that. So we're taking that for art, wine. Like, did we all know that Luray, Virginia is the new wine country? I didn't know that until people came to us and started looking at Luray, Virginia. So really, really interesting stuff there. The other areas that we focus on too is we've put together a ton of templates for operating agreements and building out a builder, an LLC filing process for those that want to put it into an LLC if it's a investment property. We also, I think 2023 was, I know, a really tough year for real estate, but actually a really good year for us to start building our company. And that was because people would come to the table, the large brokerages, whether it was Jason Mitchell or the agency or Compass or whomever, to, lenders, whether it was Rocket or New American Funding. Tomo, et cetera. And so we got a chance to work with them. I had always been pushed to put a lot more down when I was a group. And now, we have the ability to kind of lower that as well. And as low as 5% now, and, up to 4 co-borrowers. Also and have them be QM loans. Also, we're making sure that, and there's a LLC title transfer that's allowed, and there's no callback on the note. All these things that just really educating our lenders about how co-borrowers are looking at things and building the right models around that. Now, in the future, there's a few things that we're doing. Actually, I was chatting with Brian Jacobs, who I don't know if he's on the call, but one of the things that we're hoping to work with Freddie on is this notion of, can you have multiple mortgages per home based on those folks? And then also looking at risk modeling for group lending, right? It's silly to me, and actually everyone knows it at the GSEs and the lenders, that if I go in with 2 other cousins and 2 of us have great credit, one has poor credit, that they use the poor credit across all 3 of us, right? At the very least, it should be some form of weighted blended rate, right? So we're actively working with that. And then agents oftentimes didn't love groups, frankly, because groups would fall apart oftentimes. So what we had to do was really build trust with the large brokerages and say, hey, take these, we'll share these leads with you. They're already pre-approved, they're already aligned, and see what happens. And, for our lenders and our agents, our leads have been 2.5 times more effective than anything else that they've got than their averages. The other thing that's been important for us is to leverage a little bit of technology with also having a human touch point. So, we would have 1 out of 10 of our groups would convert into a sale. That would take us about 12 plus hours to service those 10 groups. In 2023, it took us about 33 and a half. And then in 2024, we're getting it down to an hour. A lot of that's through just a lot more, some automation, having more education available for people, better partnerships where we are close with folks. I think the last kind of couple things I'll talk about are, we did our first beta group, and we're coming out of this first beta group, so I want to share what we learned. We worked with a company called Built Rewards. They're a large kind of unicorn, but they help urban millennial and Gen Z renters pay their rent and get points for that rent. 67% of their 500,000 plus users said they were looking to buy with friends. So that was an astronomical amount to begin with. We opened up 100 slots, and then within 1 week got over 1,000 qualified groups looking to purchase within 12 months. We're a small team. We didn't even have a sales CRM system yet. So we just had to kind of think through that. Our goal was to create about 40 groups, because it's nationwide at 500,000 per transaction. We're actually at 25 million closed, with another 23 million in pre-approved making offers. And this is with $0 marketing spend, right? So we'll end up with kind of 60 plus transactions from this first beta group that we literally just did 1 email campaign with, and a couple articles. It resulted in about 635 discovery calls that we had time to take, 375 calls completed. From a volume standpoint, it's pretty evenly split between, kind of shift and primary multifamily. Then there were some parent-child. By actual kind of numbers, in terms of dollars, Probably multifamily is definitely the biggest. The other things were, you never know when you do this if your thesis is going to prove out, but 84% have been first-time home buyers. Now we still have like, the four doctors in the Bay Area who are buying a place in who just closed on a place in Spokane, right? And in Washington, right? Like that still happens, and we still have a lot of non-first-time home buyers, and that's totally fine. We see this as a great platform for second homes, third homes, et cetera. That being said, investment properties. That being said, our goal has really been around first-time home buyers, and we think that's where the opportunity is. 62% are professionals of color or first-gen immigrants. We think that this notion of cooperative economics is kind of inherent to a lot of these cultures, and whether it's a Susu in Black culture, or Tanda in Latino, or Hui in Chinese culture, there's these different ways of pooling capital. Interestingly enough, 15 to 20% are solo buyers. Our average transaction size has been around 800,000. And then one of the things I'm most proud of is for every transaction that closes, they tell two other groups, or they bring in at least two other groups, qualified groups for us, who are converting at a higher rate. So as we start to put money into marketing and we start to grow this segment. So we've been fortunate. We've been out for 3 quarters now. The volume has grown really well. We're making offers in 13, 14 plus cities. Bay Area obviously being a big one. And yeah, we're just really excited. We're also building out a management hub too. So as people are closing, they'll be able to capture the data for their LLC. We have CPA partners, insurance partners, all of those. We're integrating a marketplace. My wife's an interior designer, so things like taking your 30% off restoration hardware and Crate and Barrel and loading it into the system to share some of those savings with our users is exciting. And then looking at a larger financialization. So obviously the operating agreement have different terms for people to be able to sell their portion, but making that easier, also allowing for dynamic equity splits and things of that nature. So yeah, I mean, where we monetize, and obviously this is a big deal with NAR, but we do have marketing services agreements with our lenders. We do make somewhere between 25 to 40% of the buying agent fee, since we do a lot of work aligning people. That could change. It actually, to be quite honest, might be very advantageous to us because people are coming to us way before they've even been pre-approved or have an agent. And so it puts us in a position to think about that holistic strategy and bringing agents into that. And then we're building out the management platform and then being there upon exit. Yeah, we've been spending a lot of time in DC. Housing is probably third or fourth. When we talk to FHA and those folks, housing is third or fourth on the domestic agenda when it used to be 13th or 14th. So it's been really important for us to spend time with everyone from advocacy groups to policy partners, the GSEs, et cetera, and bring those all together. There are other, co-buying opportunities out there, and I always encourage people to look at those. There's ones that look at real estate more as an asset class, like Arrived, where you can put $500 or $1,000 in. Our groups are usually 2 to 4 people, right? So because the equation changes so much just by adding 1 or 2 people, right, to be able to afford the down payment or expenses. There are groups like Fractional that focus a little bit more on that investor group. Picasso, which we kind of joke is for 5%ers to feel like 1%ers, typically our older, wealthier customers. We have found that people don't love you buying a place and then fractionalizing it. They want the journey of actually finding the place together, at least our buyers. But we've learned a lot from Picasso and Fractional and Co-Buy. Yeah, I mean, our investors are 65% of color, which was important to us. We're trying to get more women investors as well, but that was really important. And we have some great advisors and things along that. I think the last thing I'll leave you with is every startup I've built, I think about a 5-year narrative arc, right? And I also think, and you all will appreciate this because you're in the real estate industry and in real estate investors too, but just this art of patient urgency. How can you act with urgency but have patience? So 2022 for us was really about validating the opportunity. 2023 was establishing the platform, building out kind of an MVP and an ecosystem. This year is really about taking those case studies that all represent millions of other buyers and sharing them with the world, which we're going to start to do more broadly starting in Q2 with a sizable marketing budget. And then 2025 is scaling the movement. And we're hoping that by 2026, we're really doing things to create structural change so that, that there's not only social proof, but now we have the structures, whether it's financial structures, legal structures, et cetera, to really support this notion of co-ownership.
That's it for this week. Be sure to subscribe to our YouTube channel and get alerts when we release our new videos. And please share the videos with your friends as well. Have a great weekend.